Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today we're going to look at Nvidia, but before we get too far along, we're going to be thinking about a paper trade that will be a long call spread, and we'll talk about that inside the options playbook. But let's take a quick peek at the markets. We're going to change things up a little bit this week. We're going to talk about last week's trade because we no longer have our stock play of the day overtime, which we used to do on Fridays at noon Eastern time. So we're going to review last week's trade that we did in OLLI, and this week we're going to start looking at Nvidia and the semiconductor space, but more so the fact that Nvidia has been had some news items this morning and the stock is up a little bit. So we got a little bit of a trend to the upside, a little bit better marketplace overall. So let's start by looking at my VIX watch list. And we see here that we have the S&P 500 index up about 2.3%. Not any heavy news as to why, except for the fact that we had a really bad week last week in the S&P 500 index. And we see the VIX around the 30% level. I've been talking about the VIX quite a bit. I do think that the 30% level makes a lot more sense for the VIX than the 25 or even 20% level. I've always been looking for that one big down move that would drive the VIX up above the 40 handle range. Actually, we'd love to see it almost reach the 50 handle range, mainly because we really haven't had that fear factor, that one moment that has shaken out all the sellers in this marketplace. And I've been highlighting recently what's going on in the VVIX index, which is the VIX of the VIX. A lot of people might not have even heard of the VVIX. You don't see it quoted on the national news that often. But I'm showing the chart of the VVIX, and this is the only thing I'm going to really focus on today as far as the VIX watch list is concerned. And if you look at it, all the way back to before the pandemic, we hit a recent low in the VVIX. Now, think of this. This is the volatility of the options that track the VIX spot index, okay? So we came all the way down to the 90% level, and it's the first time we've done that since the pandemic, since the big downturn and the huge spike up in implied volatility. We are now back down a little bit again. We're at the 106 level, which I still feel like the VIX can be used as a hedge against the marketplace. You would be buying calls because you'd be anticipating a move down in the market, which usually makes the VIX spike. And I still find it interesting that the volatility of the options inside that trade on the volatility index is at the low end of the range since the pandemic. This was a buying opportunity. We did highlight that. In hindsight, you can obviously see that you could have bought some premium. You didn't pay up for the VIX option premium. As a matter of fact, in my podcast called Options Playbook Radio, which is produced by Options Insider, I highlighted this and we actually talked about buying a VIX call option as a paper trade, as all of these are here on the Stock Play of the Day and on my podcast, because we're just trying to learn. I don't know a lot about your background, so I want to give some insights as to how to take some of the plays in my book, the Options Playbook, and use them to address situations that are going on in the marketplace currently. So let's highlight a couple of things over here on the VIX watch list. Always are interested in what's going on in the TNX, which is the 10-year interest rate. We see that the interest rate is up a little bit. More importantly, we are above 3. We had the 75 basis point hike by the Fed, and hinting that there could be more of that. We might, even though we're expecting at least a 50 basis point hike at their next meeting, could be as much as 75 for the next one too. We're at 3.3 is the yield. If you take the TNX index, you just move the decimal over one. That gives you the interest rate on the 10-year that you're receiving. NASDAQ is up again today, which is good. NASDAQ has been beaten up. It's a little bit higher than the SPX, but it is leading the indexes higher. The IWM is the Russell 2000. We're up about 2% on that. So the NASDAQ is having a fairly decent move today. Nvidia is helping that out. That is going to be the stock play of the day. Before we get there, let's talk about OLLIs and what we looked at last week. And I'm going to give you an alternative trade like I normally would in the stock play of the day. If you have any questions, you can put them in the chat box, and I will try to address them a little bit later in the show. But it's going to be packed now that we are actually doing the review of last week's trade in this week's show on Tuesday at noon Eastern time, as you know. All right, so as far as OLLIs is concerned, let me get over to the actual chart. This is what has happened since we talked about it on the show. This is a 15-minute chart. We can go all the way back to, on the 15-minute chart, we can go back to that Tuesday. This is noon Eastern time. So since we talked about the stock, we highlighted the fact that Target had some concerns as far as inventory was considered, and then also other big major retailers. We're talking a little bit about inventory and some of the trials and tribulations that they have had trying to deal with supply, demand, trying to guess what people would be interested in. And whenever there's a surplus of inventories, a company like OLLIs is very flush with cash, and sometimes they can benefit from that when larger retailers want to get rid of some of the inventory that they have just sitting on their shelves. And so we're looking for a little bit of a pop. We did a short put spread saying that if the market did come down, we don't mind buying some of this stock, buying 100 shares of it, but we bought some protection because the market is very, very volatile. So the concept was that we would, in theory, be looking at doing a cash secured put, but we're going to take some of the premium from selling that put option, saying we'd buy it at a lower price and use it to buy protection down below. Still get a decent credit in the account, and that's mainly because the markets are volatile. There's premium in these option contracts, no matter if you're looking at the S&P 500 index options or a company like OLLIs or any other retailer. The vols in general are up in the marketplace. All right, so we see stock was right around 54, 55 when we looked at doing this trade. This is that level. The market has obviously done fairly well. We dipped below for a second after the call, but now the marketplace is back up. Strong move and a very strong move today. So far the trade is working out. And let's look at the trade and then talk about an alternative if you would like to adjust this trade. Now, on trades that are winning, a lot of times you just let the winner run. And that's a very possible thing to do. Now, you can make the argument that the trade might not be winning because maybe you really did want to buy the stock. Maybe you really did want that stock to come down approximately 10% down to the $50 range. And that's where we sold our put at and say, yes, I'll buy 100 shares of this stock, OLLI, at $50. And obviously you have commissions and fees, and you got to put that into your calculations. Okay. So if we look at the actual option chain for OLLIs, we can see that this is where the underlying stock was at. It's up today. Right now we have it at $60.17. It's actually made a fairly decent move since we even started the stock play of the day. We sold the 50 strike call, bought the 50 strike put, and bought the 45 strike put. We did it for close to $1. So we had a 5-point wide spread. That means our max risk was $5. And we brought in $1. So that really made our max risk $4 on that trade. And the market has pretty much stayed flat to up, which with a real rough week last week, that's a pretty hard thing to do. And we now see it trading for about 35 cents at the midpoint. We addressed liquidity concerns, and that was a big deal about this underlying stock. And it's one of the reasons why I actually talked about it, because I do get a lot of questions about liquidity. Part of the reason why we picked a short put spread. That was one of the strategies. If you want to learn more, go back and look at the archives and see what we talked about on that concept in last week's show. So 35 cents right now. You could buy it back. It's not a bad area to buy it back at. On the show, we talked about buying it anywhere from the 10 to 20 cent range. That's what I would think about doing if I sold it for $1. That means I'm going to get 80% of the premium received if I buy it back for 20 cents. And anywhere from 80 to 90%, I always consider closing out any short spread at all. Short put spread, short call spread. Now, the concept changes if you really did want to buy the stock. So in this instance, let's say we were buying the stock. Well, the market did run a little bit away from us, so we're sad about that. What can we do now? Since we did the July 15th expiration, we still have a lot of days remaining. And remember, part of the reason why we picked this expiration is that there's only monthly expirations in this underlying stock. It does help a little bit with the liquidity because there's not a plethora of expirations to choose from. But what we're going to do is just roll up in the same expiration because we do have a profit. We're going to take some of the money off the table and we're going to reduce our risk a little bit. And so how do we do that? Well, right now we have a 5-point wide spread. We're going to actually chop that in half and go to a 2.5-point spread by adjusting this trade. So here's the way the trade would look. Where's the July 15 expiration? I'm going to show you the different expiration dates. You only have August, October, right? No weekly expirations in this underlying. And we're going to be closing these trades out, and then we're going to open up a new trade. So the new trade would be we're going to buy the 5250s and we're going to sell the 55. Now, in that instance, if we do quick math here, that's 50 cents. Same ratio as if we did the 5-point wide spread, right? We brought in $1 on a 5-point wide spread. So cut that in half. Now we're looking to bring in 50 cents on a 2.5-point wide spread. We're going to take some of the risk off of the table. Instead of having 5 points of risk, now you're going to only have 2.5 points of risk. We brought in $1 to start with, and now we're looking to bring in a little bit more credit to help offset that. It won't be exactly 50 cents because we're going to have to buy this back. So we're going to bring in a small credit, but we're going to reduce our risk. Okay. So how would this trade play out? And once again, this isn't meant to be a recommendation. I'm just trying to give you some ideas here as far as an alternative. To start with, I want to emphasize that I would probably just let this trade continue and maybe buy it back at the 15 or 20 cent range because the trade is working out. We just have a few more days going out to July 15th. We need a little bit more time decay, and maybe we can get there, right, without a big spike down. I don't necessarily know what's going to happen in the marketplace overall. All right, so we're going to hit trade. And now I need to adjust the trade because we started with a sell to open of the 50 strike. Now that becomes a buy to close. And then this is a buy to open. That becomes a sell to close. So that means we're closing out our current spread and we're rolling up, but staying in the same expiration. Now, when we do this entire trade, we're going to be doing this for a net credit to the account. In this instance, we have this trade, okay, which should be a net credit of about 13 cents to the account if we put this trade on. And that's about where we want to be on this trade. So we're going to work this order We have some wide bid-ask spread, so the bid and ask spread is fairly steep in this. And if I can roll this into, we're going to go up in strike, saying that we will buy the stock at a higher price at 55 as opposed to 50. We're going to lower our risk down to 2.5 points, and then we're going to try to bring in a net credit to the account of about 13 cents overall, bringing in our net credit to the entire trade to around $1.13. All right. Now, if you have any questions about this trade, please feel free to put them in the chat box, and I'll try to address them as we approach the end of the show. So one last thing here. I'm going to pull up the chat box here in a little bit, but let's go and just talk a little bit about Nvidia right now. So with Nvidia, what we have is, one second here. With Nvidia, we had some positive news. It's making a pretty big move today as far as Nvidia is concerned. We're up about $6 on the underlying stock. Solid move. The CEO had some decent comments about the company and thinking that they may reach their goals. There's been some mixed emotions as far as Nvidia is concerned with analysts and what the actual company is saying. But we're going to try to ride the momentum of this trade. The chart doesn't look that amazing. So let me go and highlight the Nvidia chart. I'm going to focus on this area right here, which was a previous little high that we ran off of right around the 160 area. And we're just kind of hanging out there. There's a lot of chop. I'm definitely not looking at doing a trade in Nvidia because of the way the chart looks. We're going to manage our risk, and it's a little bit of a fear of missing out type trade. We're going to ride the momentum, and how do we do that with limited risk? Nvidia is a very liquid underlying. It does trade quite heavily, and so do the option contracts. So with that said, it's still a very volatile underlying, and when you have higher implied volatilities in the option contracts, the bid-ask spread can become a little bit wide. So let me run to the options playbook real quick like here. Let me grab that. And I will show you the trade that we're looking at inside the options playbook. So now I have the long call spread. And the concept is going to be that we are just trying to ride some momentum. We want to pick our strikes so that they are within the range of the expected move. We want to be where the marketplace thinks the underlying stock could go if we are correct on our forecast. So we're going to be buying strike A. Strike A is going to be a little bit out of the money. That means that the stock is going to be somewhere in this range. And we're going to be selling strike B that's going to be further out of the money. All right. So buying the more expensive, selling the less expensive option contract. But we want to stay within that expected move. And Nvidia is very volatile. We got a big update today. So what we're going to be doing is a shorter term trade and just hope that the momentum pulls us up towards our strike B or the option contract that we're selling. All right, so let me run over to the Ally Invest option chains. We see right now that we're up 5%, 5.7%, up $9. At one point in time, we were up $10 in this underlying stock. So it was up a good chunk this morning, rode on the momentum, rode a little bit higher. Now it's came off a little bit. So that should make our trade a little bit more feasible to do. So how would I pick my strikes and how would I set up the trade for this week? We have a 10-day option contract. July 1st is the expiration. So we're looking to do this just before the holiday. We're going to go and look at the expected move. So right now with the market at 168, the most at the money strike is the 167.50 strike. So if I want to know what the marketplace is thinking by that July 1st expiration, we just look at buying a long straddle. And that helps us kind of see, well, it never has any regard to direction, but the marketplace thinks this move is feasible before that July 1st expiration date. And right now it's around 1375. It's not an exact science. That's the midpoint of it. We'll call it 14 points. So if we go up 10 points from here, that would be 177. So I don't mind selling to 180. I'm like within that range. That seems like a feasible move according to where the long straddle is trading at. So that's going to be the option contract that we sell. Let me clear this out. And we're going to go down and we're going to sell the 180s and buy the 175s on this expiration date. And this is going to be the official paper trade for this week. And let me get that in by clicking on the right rails. So I didn't highlight this, but these are the call options and these are the put options inside the Ally Invest option chains. We're going a little bit out of the money. This is a speculative trade, and I clicked on the wrong one. I need to click on this one, which is the 175. We're going to go 5 points wide. We're paying $1.49. So by doing this, we're managing our risk. Now, we needed to go at least the expected move. Now, the probabilities are saying that, it's a tough move for the underlying stock to make, to get all the way up to the 180 level. The delta right now is around 25 on that. So they're saying there's about a 25% chance or probability the stock could finish above that level by the expiration date, which is at least 1 cent above that level. So we're looking for a real good solid move just like we had today. And we need that move to continue higher. Now, we're not going to risk a lot of money because this is a speculative trade. We're looking to pay 150 on a 5-point wide spread. Our max loss is then 150. Our max upside is 350 on that trade. So this will be the official paper trade. Let me put it in the right rail. And we'll do a quick review of it. So here's what we're looking at. We are buying to open the July 1st expiration 175 call. Same time selling to open the July 1st expiration 180 call. Looking to do this at a net debit of 150 to the account. All right, that will be our max list. We'll make it 150 to make it official. And we're going to work the trade. Nvidia has liquid options. They are a little bit wider bid-ask spreads because of the actual volatility. Actually, the implied volatility is fairly close to OLLI's. It's 56% right now. Which isn't bad. That's kind of in the middle of the range for Nvidia. And we're looking at 150 here, so $150 plus commissions. You don't want to forget about those commissions. On this trade, max upside would be 350, which was 5 minus 150, less commissions on the upside, and that would be our maximum trade. Now, I'm going to run down and I'm going to highlight this. If you have any questions, please put them in the chat box, but I'm going to look at our profit and loss calculator. Let me remove the trade box. And we're going to zoom in a little bit. And you'll see here now, here's where the underlying stock is at. We're looking at a decent move to get from 175 to 180. Now, I'm highlighting because we have fairly decent implied volatility, the colored line is showing your profit and loss as of right now. Now, if the market makes the move right away, you're not as profitable on the trade as if it happens closer to expiration. And that's one of the downsides of doing a spread. An upside is that if you're incorrect, that's also the case on the downside. As I go down further and further out of the money, let me zoom in, I went the wrong way. I don't have as much risk right away until we get closer to expiration where you see the dotted line, and that highlights that's our max risk, which is $1.50. We're controlling our risk by what strikes we picked. We have more upside than downside. Usually means you're using out of the money options on a long call spread. Now, as expiration approaches, we'll go all the way down to 0 days. That'll basically, that in our calculator translate as 1 day to expiration. If we go and we look at this, now we see that the colored line is looking very similar to the dotted line. So it's a very quick trade. It's 10 days. We want to be right on our forecast closer to the expiration date, but bottom line is we prefer to just be right. And so if I do this trade and I get that move up to 180 right away, I wouldn't hesitate to just close out the trade and take some profit on it. But on the way down, you also, the same scenario. If I get the stock to give up all the gains that it had today, and it happened real quickly, I would look to just get out of the trade and try to salvage as much as I can. So if I paid 150 for it, maybe I'd close it at 50 cents. If the market did go down, that means I lost $1 on the trade. On the upside, I'm looking to close it right around $4 or $4.50, right in that range. Not looking to try to get that maximum on the trade. A lot is because we need some time decay in order to get to that maximum. But those are the ways that I would approach it. You have to decide your own risk parameters and what you think is best for your speculative portfolio. All right. So I'll go back and I'll just kind of show the trade here. Here it is, 150, and then I will ask some questions. I'll answer some of the questions that we have inside that chat box. All right. So Clinton says, Brian, would you share with us how you came to decide on the stock play on Nvidia? Well, semiconductor, I'm kind of looking nowadays, it's definitely a lot harder than it was, before the downturn in the marketplace. I'd like to try to be bullish on the stock play of the day only because people are more comfortable with bullish trades than bearish trades. So I try to find industries that have some momentum, and Nvidia is one of the semiconductors have issues, but the demand is there for their products. They have supply concerns, not quite able, recently haven't been able to meet the demand, but that's an okay problem to have, right? So if the supply chains can loosen up, Nvidia would be an area or an industry that is doing okay in this marketplace. A chart that would kind of help you out a little bit, but that has not been the case. So recently, a lot of the stock plays of the day are a little bit more news driven. Just to look even at OLLIs from last week. And also I wanted to be able to talk. I also look for trades that I can change up the strategy a little bit. We hadn't talked about a short put spread in a while. And because OLLIs was a little bit less liquid stock, it kind of made sense to look at that type of trade, not to mention maybe you wanted to buy some at a lower price. So I'm always looking at strategies that I can apply from the playbook to certain situations. I don't want to just keep doing the same trade over and over again, and all we do is talk about is a bull call spread. There's over 40 different plays in my book, the options playbook, and a little bit long-winded on that, but a little bit of a thought on it. It was a lot easier to look at bullish trades when the market was in a bull market. In general, obviously. So it's a much harder decision on what underlying stock to trade. And we'll probably try to find a bearish trade next week. It's all based off of the news because we haven't done a bearish trade in a while. Markets are we got a little bit of a run up today. We'll see where we go at. Okay. Here's one from Allison. Thoughts on buying crypto stocks right now? Well, one thing that I can't do on the stock play of the day, and I don't even want to go down there with the cryptos because it's just not a space that I'm an expert in by any means. But even if I was, that's not, we don't just give buy or sell recommendations here at Ally. We're self-directed clients. So I'd have to know exactly what's in your portfolio and do all the due diligence and stuff like that. But on crypto stocks, who knows? I'm just going to give you a little bit of a thought on it. Why would you buy crypto in the first place? Because it was going up. Well, now it's going down. So are you going to try to catch that falling knife? I've looked a little bit more into, and we've talked about it here on the stock play of the day, some of the exchanges that deal with crypto. And I would rather own something, if I was trying to speculate in this space, something that has assets. It's not, crypto is crypto. So just think about it that way. Think about in that direction. And I really don't know where the bottom may be. But I thank you for the question. And if I did know this was the bottom, I still don't really feel comfortable trying to give a buy or sell recommendation overall. And that's just very true in general. Everything that we do here is for educational purposes. All right. Well, it looks like we're at time. Thank you for your questions. Please share this link with a lot of people. Let them know all about it. We're going to change up the format. We're going to start talking about last week's trade at the beginning of the show, and then we're going to give you more detail on this week's trade. Please click subscribe, ring the bell, and you'll get all the alerts for all the stock plays of the day. Thanks for coming, everyone.